I'm guessing you clicked on this video because you've heard that options can make you a ridiculous amount of money from a small initial investment. And let me just tell you that this is in fact true. If you take a look at the gains section on the Wall Street Bets Reddit thread, you can see lots of examples of traders starting with a couple $100s and turning that into hundreds of thousands of dollars. But remember, on the flip side of things, there are also many traders that actually lose all of their money. You can see here on Reddit the many investors that have probably ruined their lives in a matter of a single trade. So remember that speculative options trading is very risky, so only trade with the money that you can afford to lose. So there are two main reasons why we might want to trade options. The first is the most common reason, which is to speculate which way the price of a stock might move in the future, and hopefully make money by correctly predicting the stock's movement. And the second reason is less known by the average retail trader, but funnily enough, it's the reason options were invented, and that is to hedge risk. Now, this doesn't sound as exciting as attempting to make so much money that you can quit your job and just basically be a full-time trader that travels the world. But trust me, it is. For example, one of the greatest hedge option plays of all time was made by none other than Mark Cuban, billionaire and owner of the Dallas Mavericks. When he sold his company Broadcast.com to Yahoo back in 1998, instead of receiving cash, he sold his company for $5.7 billion worth of Yahoo stock, but the sale came with a catch that he couldn't sell his stock for 3 years. At the time, Yahoo stock was trading for around $95 a share, and in order to protect the value of his stocks, he decided to buy put options and sell call options on Yahoo stock. Now, when the price of Yahoo stock completely crashed, down to $13 in the height of the dot-com bubble, because of Mark Cuban's Yahoo options, he was able to sell his stock for around 90% of the value of what they were when he received them. Now, if he had never bought those options, he would have lost around 85% of his net worth. So it's safe to say that without options, Mark Cuban probably wouldn't be the owner of the Dallas Mavericks today. But anyways, in this video, we're going to focus on the basics of buying call and put options on Robinhood, and how you can use these options to make money, since that's what most people are interested in. And before we get started, I do want to be honest and tell you that I am not an expert in any way, shape, or form off of the strategy of profiting off options. I just know how they work. Although with that being said, I did once buy a call option contract for AMC stock at $83, and I sold it literally just 2 days later at $1,140 for a 1,273% return. But I'll admit that that was totally pure luck. And if the AMC army didn't decide to stick it to the hedge fund shorts by pumping the stock, I could have just as easily lost that $83. Alright, so let's get into it. Let's talk about exactly what an option is. An option is a contract that gives the buyer the right, but not the obligation, to buy in the case of a call, or sell in the case of a put, the underlying asset at a specific price on or before a certain date. So you can buy a call option and sell a call option, and you can buy a put option and sell a put option. In this video, we're going to keep things simple and just cover buying call and put options. So let's first start with why we might want to buy call option contracts. We want to buy a call option on a stock if we believe that the price of that stock will go up in the future. And as you can see here, buying a call option contract gives you the right to buy 100 shares of the stock at the strike price by the expiration date. Now, the best way to truly explain what this means is by looking at an example on Robinhood. So let's just say, hypothetically, based on our analysis, we believe that the price of Twitter stock is going to go up in the future. Currently, Twitter stock is priced at $60 a share. So let's say that we predict that the stock is going to go up in price to about $70 within 1 month. So we choose an expiration date for the option longer than what we think it will take for the price to increase to $70. So in this case, in 1 month, that would be July 16th or later. We can see that the later the date we choose, the more expensive the option is. And that's because it's less risky to buy an option with longer expiration dates, because it allows for more time for the price of the stock to change and thus for your prediction to be correct. And because it's less risky, it costs more to purchase. Whereas on the other hand, if you were to buy an option that expires in a few days, there wouldn't be much time left for the stock to move the way you want it to. So there's a lower probability of making money from that option, so therefore the cost of the option is cheaper. So for this example, we're going to choose July 30th, since we think the price is going to increase within the next month. This expiration date gives us a little buffer in case the stock takes a little longer than we think to make the move upwards, but not so long that the options cost a lot of money. So now we can see a bunch of numbers, so let's go through those. The large white number is what we call the strike price, which is the price of the stock we can exercise the call option at. Below that number, we have the break-even price, which is the minimum price Twitter needs to reach for us to make a profit. And the number on the right is what we call the option premium. And this number multiplied by 100, because the options contract equals 100 shares of the underlying stock, is what we actually pay to purchase the option. So in the case of this $65 option, the premium is $2.76. So if we multiply that number by 100, the cost of purchasing the contract is $276. So each of these rows here are separate option contracts. So now let's take a look at one of these options. So let's imagine we believe Twitter will increase to a price of $70 in the next month. This means that we should consider any of the options with a break-even price of less than $70, since that's what the stock price is going to have to reach for us to make money. And you can see that the lower the strike price of the call option, the more expensive the premium is. And that's because the lower the strike price is, the more likely the option is going to be profitable because the stock price doesn't have to increase as much. So basically, the higher the strike price you choose for call options, the cheaper the options will be. But also the less likely they are to be profitable. So let's take a look at this $65 call option here. So we're going to assume that we're only purchasing one contract for a cost to us of $276. Now this $276 is the maximum amount of money we can possibly lose. And that happens when the option expires completely worthless, which is what option traders call expiring out of the money. So if we take a look at Robinhood's option profitability graph, we can see that if the stock price on Twitter expires at a price lower than our strike price of $65, it will expire out of the money and be completely worthless, meaning that we will lose our investment of the $276. But if Twitter stock expires above $65, which is what we call in the money, then the option will be worth something. How much it's worth depends on how much the stock price rises. We can see that in order to break even, the stock needs to reach a price of $67.76, which is the $65 strike price plus the option premium of $2.76. And if the price rises above our break-even price, we'll make a profit. So earlier, I said that we think Twitter will be at $70 in a month. So if our prediction is correct, we will make a profit of $224. And now that options definition I quoted earlier will start to make a bit more sense. Because what happens in this example is we pay for the right to buy 100 shares of Twitter in the future at a price of $65 a share. So if the price of Twitter increases to $70, we can buy 100 shares of Twitter at our $65 strike price and then instantly sell the 100 shares for the current $70 price, which gives us a profit of $500. Then, after subtracting $276 for the cost of the options contract, we receive a profit of $224 like I mentioned earlier. And you can see how powerful and risky options can be in comparison to buying stocks. In this example, if we were to invest $276 in $65 Twitter call options, and if the stock increases in price from $60 to $70, we would make a $224 profit. Now, instead of buying the options, if we were to have bought $276 worth of actual Twitter stock, and in the same way Twitter stock increases in price from $60 to $70, then we would only make a $46 profit. But on the flip side, if we bought $65 call options and Twitter stock increases from $60 to only $66, below the break-even price of $67.76, we would lose $176 of our $276 investment. Whereas if we bought the stock, we would actually make $27.60 in profit. So again, this is why options are just very risky. Okay, so now let's take a look at buying put options. This is like call options, but in reverse. So we want to buy a put option on a stock if we believe that the stock will go down in price in the future. Let's imagine now we think Twitter stock will decrease in price in the next month from $60 to $50. Now we want to choose options that have a break-even price of $50 or more to be profitable. So let's choose this $55 option. Now the price has to decrease to below $55 for the put option to expire in the money, and will break even at $53.09, which is the $55 strike price minus the $1.91 option premium. And if our prediction is correct and the price decreases to $50, then we will make a profit of $309. Okay. So now that we've covered examples for buying call and put options, the last very important thing I want to cover in this video is that you don't have to wait till the expiration date to exercise your option. You can actually exercise your options early before the expiration date. So you might want to choose to sell the options that you bought to maybe lock in a bit of profit, or maybe to cut some losses. The price of the option you bought will actually change in price depending on how the price of the stock changes. So let's say, for example, you buy the $65 Twitter call option. Let's say the price of Twitter the next day increases from $60 to $62. So maybe it's not currently in the money, but the price of the option has increased and is now more expensive to the other traders to buy it. So you can actually switch over to the sell section and sell that option to another trader to lock in some profits. Alright, so that's it for the video today, guys, and I hope you enjoyed this options for beginners video. I only covered buying options today, but if you would like to see a second video that covers selling options, which I would argue is just as important as the buying portion and is something that every single options trader should be comfortable knowing, then make sure to comment down below if you want to see that part too. And make sure to like the video and subscribe for more content. I'll see you guys later.